Welcome to Crypto Alpha Edge, your daily crypto market recap 2025. Today's briefing is structured across key themes to help you stay informed and ahead of the market. $588 million poured into Bitcoin ETFs in just one day. BTC is now squeezed inside a tight zone between $106.5 thousand and $107,000. This is no ordinary range. It's a historical supply wall. Miners are holding, institutions are buying, and yet price refuses to move. Is this a calm before the breakout or a trap before the dump? Market overview. Today's edition of Daily Crypto Insights focuses on Bitcoin's make-or-break setup, driven by ETF flows, macro tailwinds, and price compression near key resistance. ETF flow surge. U.S. spot Bitcoin ETFs recorded an inflow of $588 million on June 25th, the highest single-day inflow of the month. This marks 11 consecutive days of positive inflows, totaling over $3.9 billion since June 10th. BlackRock, Fidelity, and Bitwise all saw dominant contributions, suggesting institutional confidence remains high. Price compression at resistance. Bitcoin is consolidating tightly in the 106.5K to 107K range, a known historical supply zone. This zone previously triggered local reversals and short-term rejections. Price volatility has dropped sharply, classic behavior before breakout moves. Traders are watching this zone as a technical battleground, one that often precedes either an explosive breakout or a failed rally. Historical parallel. This isn't the first time we've seen price compression paired with ETF inflows. Back in January 2025, Bitcoin hovered around $47,000 with over $700 million in ETF inflows. Days later, it spiked to $52,000. That move unfolded fast, within 72 hours. The volatility structure, RSI slope, and volume signatures look eerily familiar to today. On-chain signals. Exchange balances remain low, suggesting reduced sell pressure. Long-term holders, including miners, continue to accumulate. Miner reserves are up 4,000 BTC since April. Satoshi-era miners have barely moved coins, under 150 Bitcoin sold this year. Whale inflows are muted, which often precedes reaccumulation cycles. The conviction from major holders is growing, even as price stalls. Retail sentiment shift. Retail sentiment has cooled. The Fear and Greed Index slipped from 73 to 59 over the past 5 days. Meanwhile, funding rates have turned neutral, suggesting traders are unsure. This type of hesitation, paired with strong institutional inflow, is a setup we've seen before major breakouts. Retail hesitates. Whales accumulate. Macro tailwinds. The U.S. dollar index just touched a fresh 2-year low, favoring Bitcoin as a macro hedge. Tech equities are rallying, and risk sentiment is improving globally. Tensions between Israel and Iran have eased temporarily, giving space for capital to return to risk assets. The macro environment is aligning with crypto once again. Trap zones to watch. The area just below $105,000 is loaded with liquidity, prime for fake breakdowns and stop-loss hunts. Similar moves occurred in early June, where price briefly dipped below support before rebounding $5,000 within hours. This type of volatility shakeout is common before directional confirmation. Strategic levels to monitor. Immediate support, $105,000 to $106,000. Compression zone, 106.5K to 107K, current battleground. Breakout potential, above 107.2K could target 110K to 112K and test prior all-time highs. Breakdown risk, below $105,000 may revisit $103,000 or fill the CME gap. Conclusion, Bitcoin is cornered. ETF inflows scream institutional optimism, while price action stays frustratingly still. But stillness isn't weakness. It's often the fuel for violent breakout. Retail is cautious, miners are stacking, and ETF capital keeps coming. Over the next 24 to 48 hours, volatility will return. The only question is, will you be on the right side of the move? This has been your daily institutional-grade crypto briefing from Crypto Alpha Edge. Stay sharp, stay early, stay informed.